All right, everyone. Thank you for joining us today. We will be covering, excuse me, we'll be covering checkbook control IRAs, utilizing different types of structures underneath of an IRA to attain checkbook control, as well as the basics of what types of accounts you can use and a lot of other very useful information. A little bit about myself. I will be your moderator today. My name is Alex Perney. I've been with Advana here since 2012. I'm a member of the American Banking Association, and I also hold my designation as a certified IRA services professional. So please make sure that if you have any questions, even if they don't necessarily pertain to checkbook control or just to the specific scope of the IRAs that we're covering today, ask them. I can probably answer them, and I'm always happy to do so. And also understand that the broad scope of what we're going to be talking about can be applied to a lot of different areas of retirement planning. So don't just take it as the very slim area that we're going to cover today. Make sure you understand that this can apply to a lot of things as well. And I do encourage you, please make sure that you do ask your questions, get them in there, type them into the chat boxes. It does help to enrich the presentation for everyone involved. Please make sure you get those in. We can certainly get those addressed as they come up. I see a couple of rolling in. Let me just get a little bit done with the intro, and we will answer those. So a few key points that I want you to take away from today: what accounts you can self-direct, what is the difference between an IRA administrator versus a checkbook control model, and the advantages and disadvantages of using checkbook control in an IRA, because not everything is going to be solved essentially with utilizing a checkbook IRA. There are some things that you give up, and there's some advantages that you do gain with it. So understand that this is not something that's going to be looked at through strictly rose-colored glasses, that you do need to understand that there is a trade-off in that. We have two main locations. Our main office headquarters is located in sunny Largo, Florida, in the Tampa Bay area, and we also do have another office in Georgia. Although if you are located anywhere in the country or world, as these webinars tend to reach sometimes, understand that we can operate anywhere. So long as that you have a computer and a good internet connection, we can pretty much always get stuff done, and get stuff done timely for you as well. If you have any questions following up on this presentation, always feel free to give us a call. We do hold these events just about weekly. We host everything on our on-demand portal through our YouTube channel as well, and we also maintain an up-to-date blog as well with things that are going on in the industry and different trending investments and the like. Now, we do have a few questions that have rolled in, so let's go ahead and get those out. John asks, once in a checkbook IRA, as a traditional IRA, can it be converted to a Roth easily, besides taxes and any administrative costs to convert? Yes, the answer is certainly. It just depends on essentially what you have held in the LLC that would potentially cause any issue with you having a certified third party evaluate it. Essentially, anytime we do a conversion of any type of asset, we just need to have a certified valuation done of it. So a qualified independent third party, such as an attorney or CPA, would need to give a value to the LLC, and then it would just be a matter of us doing the conversion in our system and reporting it. So you would be assessed the taxable liability on Form 1099-R, and also making sure that whomever is helping you with that can also address the assignment of that membership into the new account, but really not too problematic to do that. And then after converting my IRA to a checkbook IRA, later can my separate 401k funds be moved if I change jobs? The answer is yes. So if you have an employer's 401k, then you terminate employment with them and you would like to move those funds into a self-directed IRA, you can certainly do that. There's not a problem with it. And can we use checkbook to invest in cryptocurrency? Certainly. That is currently the method that we do have to point clients in right now. We are trying to hopefully get a platform developed where we can have clients do it directly in their IRA without an LLC or a trust. But presently, utilizing checkbook control is the method that we would need to do if you were interested in cryptocurrency. All right. And then, John, it would just really kind of depend on which ones you're using. The big ones out there, such as Coinbase, Kraken, and the like, are the ones that I always point clients to and that clients have had good success with. All right. Why people haven't heard of a self-directed IRA? The entire industry really is made up of what we do is less than 4% of the retirement assets out there are going to be truly self-directed. So it is a very narrow scope of self-direction that is encompassing what we do. So understanding that just because it's not necessarily prevalent as something you've heard about, it still is a very proven method of investing your IRA funds. You've been able to do these types of investments, alternative investments to what you've been provided to you by your bank since 1975 with the passing of the ERISA bill, which essentially created IRAs. So the Employment, Retirement, and Income Security Act of 1974 created IRAs, but it didn't necessarily define what the investments could be. It gave general guidelines. And you've been able to do this kind of stuff for a very long time, but due to large banks and investment providers giving a very narrow scope and having a lot of the market, it's why people typically haven't heard of it. So just because you haven't heard of this, don't think that it's something that's inherently new or trendy. It's something that certainly has been done for a long time. It's just not a very large piece of the market. Okay. Again, Dave, we just answered that question. It would just really be up to you as the manager to determine which one you'd want to go with. Places like Kraken or Coinbase, I would always point people to exchanges that want to utilize more of that cater more towards businesses and custodial accounts. They would be the ones that would be more apt to do it. We've had clients that have had luck with Coinbase and Kraken, so it just depends on which one you kind of would rather go with, and ultimately do the research. You can really utilize whomever you'd like to if you are going to utilize cryptocurrency under an LLC, but ultimately at the end of the day, it's the manager's decision as to what exchange they'd like to go to, or you could do private purchases from individuals as well. Okay. Charlie, what is a checkbook IRA? We're going to get into that here in a minute. How is it different from Roth? We will also cover that question as well. And do we have clients on GDAX? Camellia, currently really with the marketplace, we're not always privy to the information of what exactly our clients have chosen to do after they do checkbook control, as you'll see a little bit later in the presentation. The control and the actual decisions being made outside of Advanta really don't lend us always to knowing what they have done. So the potential is yes, but in all honesty, we just don't have that information always. Okay, so now into how to fund your account in order to get started. So with regard to your IRA, as someone previously asked, if you have an old employer's 401k, understanding how to move that money in is really important. Art, I do see you have your hand raised. If you could please type in your question, we would be happy to address that. So how to actually get money into the account. So if you have a like type of account, you can do a custodial transfer. It's quick, it's easy, there's no reporting done on it, and there's no restriction on them. You just need to have a request sent to your IRA administrator from the current IRA, being Advanta in this case, to move the funds over to the current platform. And then afterwards, you are then ready to invest. If you have an old employer plan, utilizing the method of a direct rollover is how you would move those funds. And understanding that there is specific tax reporting that goes along with this is also very important. So with the direct rollover, you will be actually requesting a distribution of funds from the current administrator of the 401k, in this case, whomever your current employer is that had the 401k plan, and then they will directly roll them into the IRA that you have chosen. Now, understanding that there is tax reporting in this is really important because transfer and rollover get interchanged quite a bit in this area. So understanding that there is a difference and there is reporting done with one versus the other is very important. Okay, John, great question. So the one rollover per 12 months applies to indirect rollovers. And there's essentially, let me go back one slide, there's essentially a few different types of rollovers that you can do. It's actually this slide. There's actually a few different types of rollovers you can do. One being the indirect one, where you actually receive the funds personally, deposit them to your personal bank account, and then have 60 days from the day after you get those to put them back into an IRA without paying taxes. That you can only do once per every 12 calendar months. Direct rollovers, where you have your 401k administrator, let's call it Charles Schwab, send the funds directly to your IRA custodian, those don't count towards that limit. And IRA to IRA custodial transfers are going to be unlimited as well. So those don't count towards your rollover period either. But very good question. It's important to understand how those play out. Okay, Art's question. I want to invest in a new business with my son. I will use my IRA LLC checkbook and he will use his funds. I understand this is okay, but can he be paid officer in the business if I invest less than 50%? I would very much caution you to get good advice on that because that seems to me to be bordering really on an issue of possibly being not allowed, just with the fact that if you are forming a new LLC, with a disqualified individual, the partnership in and of itself is fine, but for him to then in turn be getting a direct benefit from it, even if your IRA has less than 50%, it just gets to be kind of some gray areas right there. I would encourage you to seek some legal counsel on that one. It's just kind of, when it comes to specifically the paying him a personal salary out of that, that's where I would really encourage you to get some legal advice because the actual structure is not an issue. It's just that the salary payment really would kind of play into that with potentially being not allowable. So right here we have the understanding of the self-directed type of plans. Now these are going to be really important because the cool thing about this is you can self-direct any one of these, and you can also do checkbook control with any one of these, and some of them have more than one way to do checkbook control. So understanding how this all works is really kind of cool, and especially when you see this slide, you'll really kind of see how this expounds into not just being a tool for just the Roth or just the traditional, or, oh, I don't qualify for a 401k, so I can't do checkbook control. It's certainly not the case. There are many different ways to get this done, and we're going to kind of work from left to right and explain how that is done. So the traditional IRA is the most common account out there. It is going to be the one that you get a deduction for adding money into, and all of your money will grow tax deferred until you'd like to take money out of it, in which time you will pay your marginal tax rate on those funds. Now, with a traditional IRA, old 401ks or old employer type of plans such as governmental 403bs or armed services thrift savings plans, all of those can be moved directly into a traditional IRA without paying any type of taxes. It just goes directly into that. It's a direct rollover, not a problem. So that's why it's such a popular plan out there, because a lot of people don't want to pay a very high tax bill just to have something put into a Roth. And we'll cover the inherent big benefits with the Roth as well in a moment. Now, with a traditional IRA, you are limited to $5,500 a year of money that you can take out of your own personal pocket and put in there, and up to $6,500 if you are over the age of 50 and a half. Now, those same contribution limits are going to be applied to the Roth IRA, but the cool thing about the Roth IRA is that you're making all the contributions in there after you've already paid taxes on the money. So since you've already paid taxes on those funds, it all grows tax-free. You pay no taxes on it at the time of the investments, nor when you actually take the money out, which is incredibly cool considering that taxes tend to have a way of going up over time. With the new tax bill, there might be some inherent tax breaks that people are seeing in the immediate, but over the long course of time, the trend is for higher taxes. So being able to take your taxes and essentially take that hit now and then have everything growing without any type of taxes ever having to be paid is certainly a very attractive option as well. Now, the ability to self-direct plans is not simply just located in the individual type of plans. There are business plans that you can utilize in order to self-direct as well, and you can also do checkbook control with all of these as well. Now, the SEP IRA, which is the Simplified Employer Pension Plan, is the newer version of the Simple IRA and a very distant cousin of what the individual 401k plan is as well. The SEP IRA is really good for individuals that are making a high earned income wage. So if you are making high salary wages as a self-employed individual, you can potentially get up to 25% of your base salary into that plan, not to exceed $54,000 per year. So you're able to reduce your salary and then contribute in a much higher amount per year than you would with a traditional or Roth IRA. But in order to qualify for that type of plan, you have to have very high earned wages in order to, make that calculation work. The Simple IRA, it's not something I'm going to get into a lot of detail here, as it is a little bit more complicated than most. But the individual 401k plan is something I do want to spend a little bit of time on because it is a very attractive plan to a lot of people. I've got a question rolling in. Sandra asks, can I roll over my HSA to a self-directed IRA and have the same benefits as the HSA, where I can utilize you wouldn't need to do it to it. I mean, you could just self-direct your HSA. I mean, there's no reason to roll it over to a self-directed IRA. We can administer a health savings account here, and you can self-direct it. So the answer to your question is no, but you wouldn't need to. You could just put it directly into a self-directed HSA and use it for health-related expenses. So not a problem there. Now, getting back to the individual 401k, and Sandra, thank you very much for your question. The individual 401k plan is an interesting topic on this because it allows for two different ways of being able to do checkbook control. Unlike any of the other ones, this one is very unique. And it's also unique in the fact that you can get a lot more money than any other plan into there on an annual basis. So in an individual 401k plan, you have to have a business. You can either be a sole proprietor, you can really have any type of structured business you want, but you have to have self-employment income or some type of income from a business that you establish. And the individual 401k specifically, you can only establish this plan if you are an owner-only business. So essentially all the employees would have to be equity owners of the business. You couldn't have any rank and file or hourly employees, and your spouse can work for the business as well. If you do want to have other employees or you have other employees, the plans get a little bit more expensive to administer, and you would need to get an outside third party to do some of the compliance paperwork for that. But let's just say the individual 401k plan. In this plan, you can defer up to $18,000 of your personal salary into that plan per year, up to $24,000 if you're over the age of 50 and a half. And then also you can contribute up to 25% of your net operating income of the business as a profit sharing match to all the individuals participating, not to exceed $35,000 per individual. So you can get almost up to $60,000 a year into one of these types of plans, thereby creating corporate and personal deductions. And the cool thing about this is that you don't always have to use an LLC underneath of this plan in order to do checkbook control. If you want, we offer a platform where you can just essentially lease the bare documents for doing your own 401k, open up your own bank account for that 401k, and take on all the record-keeping responsibilities for it. And then you have automatically a trust checking account for that 401k that you as the trustee are writing the checks out of while not having to utilize an LLC like you would in all of these other types of plans. So if you have the individual 401k, there's some potential to do things a little bit differently and maybe even a little bit cheaper than you would in some other types of plans. Something to think about, but again, we're going to get into some of the trade-offs here in a few minutes. Robert asks, can I combine Checkbook IRA LLC funds with personal non-IRA funds to flip homes? The answer is yes. You have to do it correctly, but you certainly can. Essentially, the way you would need to do it, well, there's a few different ways. You could do it as your IRA wholly owning the LLC and then doing tenant and common partnerships with yourself personally. So the LLC would be 50% undivided interest and you would be 50% undivided interest in the deal. Each of you, the LLC and yourself personally, would be responsible for half of all expenses, but you would also get half of the income as well from any type of sale of property that's done in that method. Now, what you really need to watch out for in there is that you can't utilize your LLC or your IRA-owned LLC just for an initial purchase and then do all of the work yourself, or then go out and fund all the rehab yourself without your IRA paying for it. It has to be done as a true partnership where everything is split exactly along those lines, but you can certainly make that work. Now, you don't have to partner like that. You could be a partner to the LLC initially, so you could just pull the funds into the LLC and have the singular LLC writing all the checks and everything, which might make it a little bit easier than having to have two people write stuff. But there's a few different ways to do it, but essentially the basis for that being an allowable investment is there. Now, the education savings account or the Coverdell account, there still is some up in the air. Still a few things up in the air with the tax bill about if this is actually going to be disallowed or not. I would assume we're going to have to find out in the next few days the finality of that. But if you're looking to establish a Coverdell education savings account, although they do have a $2,000 per year contribution limit per beneficiaries, so each one of your children, you can only put $2,000 per year into those plans, I'd encourage you to call us if you want a self-direct one, because they might be going away, but they will be grandfathered in regardless if you would like to establish one. Not as popular to self-direct just because of the low contribution limits, but you can certainly self-direct that. The health savings account, absolutely being able to self-direct, as we covered with one of the questions over there. You can either have a family or a individual plan, and then I have courses strictly on just everything that goes into a health savings account. So a little bit of good information here. Anyone that signs up will get copies of the slides for this, so please just kind of utilize this to maybe confirm some of your notes while I get a few questions answered. Okay, John, great question. Do the terms checkbook control and self-directed have the exact same meaning? No, absolutely they do not. Checkbook control is only in reference to a certain type of investment structure underneath of a self-directed IRA. A self-directed IRA just means that you as the individual account holder are selecting the types of investments that you'd like to do, and in the scope of what we deal in, checkbook control really means that it's not publicly traded assets. So even though you can some people, and I think Fidelity is the big progenitor of it, saying that, hey, you're self-directing your IRA. And what we do, you're just picking stocks and things like that. And what we do, you're actually picking truly self-directed investments, meaning that you're going out and finding a piece of property you want to buy in your IRA, or you're going out and finding a private company to invest in, or forming a new LLC for your IRA to invest in. So checkbook control and self-directed are two completely different terms that mean two separate things. But very good question. Thank you for asking. All right. Richard asks, I max out my 401k, $59,000 with my employer. Could I still fund an individual 401k? Or you're going to be disqualified from essentially establishing multiple 401ks just to max them out. You can be covered by multiple ones, but you can't necessarily max all of them out. So if you're already maxing one out, you could stop your participation in that plan potentially, and then establish a 401k, individual 401k for another business you have, and then only participate in that one if you wanted to kind of shift where you're putting those funds into. But you couldn't, essentially do that for multiple plans. But there's definitely tax strategies that would allow for you to, get to where you're going, but you couldn't essentially have multiple ones. That'd be pretty nice, though. That would be nice. So investment options. Now think about everything here on this page, all funneling directly into the single member LLC button. So real estate, notes and mortgages, futures, foreign currency, private placements, everything on this slide can be done directly in the single member LLC. It can be done under checkbook control. And the nice part about that with utilizing single member LLCs and checkbook control is that if you're looking to do a lot of diversity, if you're looking to do maybe a few notes and then some foreign exchange and maybe a little bit of futures trading, you can really help reduce your fees by using a single member LLC, because if you're going to be doing a lot of stuff and having high transaction volume, the single member LLC can kind of shield you from some of the administrative costs of a self-directed account by only ever having one asset in your IRA. So the LLC, in this case, that Advanta would administer, would be the only asset that we would ever assess fees to. You could have 3 notes, a foreign exchange account, and a small private placement in that LLC, and it wouldn't increase your cost basis at Advanta at all. One of the big advantages to that type of investing with utilizing a single member LLC. Now, all those things are really nice in looking at what exactly you can invest in, but there are a few things you cannot invest in with an IRA, and this does extend into the checkbook control arena as well. So an IRA cannot be the direct holder of a life insurance policy. They're typically paid out tax exempt, so there really is no need to have one held in an IRA. So the IRS says, nope, can't do life insurance. Also, you cannot hold anything in an IRA that derives its value from collectability, so something that's incredibly subjective. Now, obviously, everything is only worth what someone will pay for it, but Things like rare bottles of wine, antiques, artwork, stamps, certain types of coins. You can't invest in those things because they are almost impossible to assess a readily determined value to. Just because someone doesn't want to live on one street, everyone can pretty much agree that that property is still worth something. Uh, you know, Things like stamps, if you can't use it and it's only valued at what someone is willing to pay for it on a collector's market, that's where they kind of want to draw that line. Okay. Joseph asks, can a single member LLC have properties in it? Absolutely. You can certainly buy real estate. A lot of our clients that do real estate, I'd say about, it kind of fluctuates, but roughly half of our clients that come in and do real estate funnel it through some type of Checkbook Control LLC. So it's absolutely not a problem to do that. Okay. Do coins ever have numismatic gold and silver? Okay, yes. So the certain types of coins that you can invest in would be ones that are traded for their bullion content value, meaning that you can buy silver coins, gold coins, platinum coins, and palladium coins, but they have to be of a minimum fineness standard. Typically look to any government-issued coins, so the American Eagle and the American Buffalo series of all those different types of metal coins will qualify for IRA investments. The ones issued by Canada, China, Australia, Great Britain, all those types of precious metal coins that are just traded on their content value of the precious metals, those are IRA qualifying investments. One interesting aside to that is that the South African Cougarand, albeit a very popular investment for that area, does not actually qualify for an IRA. It doesn't meet the minimum fineness requirements. And there's also some people that you cannot deal with. So as a few people had posed the question of maybe partnering with a child or another family member, you can certainly partner with really whoever you'd like to, so long as that equal consideration is being given to everyone that is participating in that deal. However, there are people that you cannot directly transact with, meaning that I can't just go out and buy something from certain people. Let's say my spouse owned a house that she had before we met. I could not buy that from her. I could not buy my parents' house, or I could not buy my children's house. So basically anyone directly up and down from you in your family tree is going to be what's called a disqualified person. Now, doing business directly with these people will essentially cause a lot of issues for you and can potentially blow up your whole IRA. If you ever want to deal with these people, you always have to do it as a partnership, and you can't purchase anything or sell them anything directly. So if your son and yourself want to go out and purchase a house to flip, you can certainly do that, but you have to do it as a tenant in common purchase. It has to be done as a complete partnership. It can't be done on opposite sides of the closing table. All right, had a couple different questions roll in. John asks, crypto coins don't count as coins, right? Correct. Cryptocurrencies are considered personal taxable property. There are some proposed tax changes as to how they will be considered, but the crypto coins really are in a completely separate field from physical, tangible coins. Okay, with Damon asks, with coins, isn't gold and silver to hold through an intermediary? I think what you're talking about is yes, you do have to hold that at a qualified third party. Essentially, you would need to have a safekeeping institution hold it. You couldn't necessarily hold it yourself, even if you have a Checkbook Control LLC. It's not our place and legally cannot advise you on how to do things. Essentially, if you have an LLC. But I would highly encourage anyone that's looking to do that type of investing, utilize a safekeeping storage facility. There's places out there that specialize directly in holding precious metals for people as investments. The one I would point everyone to into doing some research in would be Delaware Depository. They handle all the safekeeping requirements for most of the commodity exchange markets. A lot of our clients use them. They're a big, very, very well-known and experienced safekeeper. Utilizing them or someone like them is who I would point people to. But essentially, you as the client are the one that's going to be making that ultimate decision as to where you would like to hold something like that. Can I buy copper bars and store them and store in my Checkbook LLC? Robert, I would say that's a good question. It's a very interesting one too, because if you look at it from the perspective of purchasing things for a commodity, it certainly would potentially pass a lot of tests to say that yes, this would or wouldn't be allowable. It's just honestly something I've never been asked, and I haven't ever seen someone do it, so I don't have much of a basis to say yes, copper would be an acceptable investment, with the exception of the fact that there's a readily determined value to it. It has markets just like something like gold, silver, platinum, steel, iron, and other types of scrap do. The one thing I would and I can give you guidance on is that I would never hold it. If you're holding like a tangible asset, never hold it yourself. So if you have Checkbook LLC and you buy a safe, taking a gold coin and putting it in that safe, I would highly caution against that, or any type of physical asset, because it also goes that, as you can see up here, I'm not sure if we have a slide pointing that out, but you can't utilize the asset directly if you're holding it in an IRA, especially an LLC. And for you to actually pick up, something that is, essentially a bearer instrument, meaning the holder of it is the owner of it, that would be something that I would caution you against. But it certainly is an interesting fact, and there would certainly be some trains of thought out there that would allow for you to buy copper, but I just haven't ever seen it before, haven't read any literature or seen anyone have experience on it, so I would be hesitant to kind of give you a thumbs up or thumbs down on that one. Let's see. Sandra asks, how do I utilize my self-directed IRA to purchase rental properties to avoid all income going back into the IRA accounts? So Sandra, if you could please type in, are you trying to get money personally in this scenario? I think that's what you're hinting at. If you could just let me know, I will certainly be happy to explain. Okay. Essentially what you would need to do is you need to partner with your IRA. If you want to get some personal income, essentially you got to bring something to the table in that. You can't necessarily, well, actually, I shouldn't say that. There's a few different ways. You could partner with yourself, and then your personal portion would be coming back to you. So if you own 20% of the property or were 20% partner in the deal, you would get 20% of the income and have to pay 20% of the expenses. If you wanted to take some of the money, you could just have your IRA purchase the whole thing, and then and if it's in an LLC, you would just write a check back to your IRA, and we could distribute some to you. You would potentially have to pay taxes on a portion of it. If it was held in a traditional IRA, you'd be paying your ordinary income taxes on that. Or so you'd have to have that into consideration. So you could either partner with yourself and be utilizing your personal taxable rate for an investment, or you might be able to get a little bit lower if you are doing it to where it's distributed. So that way you're only paying marginal ordinary income as opposed to getting hit with maybe sales taxes and things like that. So things like that. You could not write your LLC a note. No, you would have to be a partner. You could not loan money to your IRA-owned LLC. Okay, Benedict asks, not holding assets in personal storage, how does this work for crypto coins when one wishes to use a hard wallet, not on the exchange itself? Doesn't that contradict the general rule of assets like to be held at a third-party storage facility? It does bring up a few contradictions. It certainly does, Benedict, and it's a good question to pose. I would say that, certainly if you want to get your cryptographic currencies off of an exchange wallet, it certainly would be a very sound course of action. It really ultimately, obviously, would be up to you as to how you'd like to do that. Kind of going in the order of secure to least secure, being something on the lesser end being on the exchange, something that a third-party provider that does cold storage or would potentially offer offline storage would be in the middle to the most secure, and then obviously the hardware completely offline personally held one would be on the higher end of security. The problem is that there is no way to essentially title that if you're actually personally holding that, and we've kind of broached that subject with us as a company. Is that ultimately it's going to be up to you to make the right decision with an LLC. You have a lot of that, and we will be getting into some of the downfalls, and that can potentially be one of them. But if you had the ability to have some type of third party, take that offline and then put it in some type of storage for you, that would be kind of along the same lines as having a third party gold storage facility do the safekeeping for that asset. I would just always caution against, the second you take that flash drive out of your computer, the holder of that, if you're the manager of that LLC, essentially is the owner of that. There is no way to tie a name to it. When you're utilizing, a third-party wallet provider, someone like, let's say, BitGo, in that case, you can actually assign a name and put and title the asset and the holder of that to a particular name. So, whereas it may be the most desirable way to hold those types of assets, it may not always be administratively feasible to do it with the rules and regulations regarding a IRA. Okay, Richard, ask a question. Do you have any idea how often Checkbook IRA LLCs are audited by the IRS? I do, and that it's not often, and for the big reason is that the IRS doesn't know what you hold in your IRA. The reporting that we do on an annual basis for an IRA is what's called IRS Form 5498. And on that form, there isn't anything where we tell the IRS what you're holding. So if you're holding real estate, if you're lending notes, if you have private placements, if you're doing, if you're buying farmland, the IRS doesn't know what you hold. The only way they find that is that you're going through a personal audit, and they extend that to your retirement accounts. Now, the LLC, the entity itself, could potentially get audited, but it's just one of those things where, depending on what you're doing, the normal audit risks that are in the normal atmosphere of investing and things like that are going to exist. Now, Checkbook IRA, the LLCs typically don't have to file tax returns because they're owned by a tax-exempt entity, be it the IRA, but its best practices will keep you from running afoul with the IRS. But the IRS doesn't necessarily know, particularly per our reporting, if you're holding an IRA-owned LLC, if you're holding real estate directly. They just get a report of value, the fact that you have an account with us, and if you've done any qualifying rollovers, and if you've reached the age of required minimum distributions, which is 70 and a half. So, from that standpoint, it's not something that they can necessarily target now. But, it's not something that is particularly an audit risk by any means. So understanding where the responsibilities lie is kind of a good segue with a few of the questions that we just answered to the differences and the potential advantages and disadvantages of utilizing a Checkbook Control LLC with an IRA. Now, with a custodian administrator account, so doing everything directly here with Advanta, and Robert, good question. I'll get to that in a moment. You have the advantage of us having a hand in everything. Now, some people might see that as a disadvantage, and rightfully so. If you're trying to do something extremely quick, or you really want to have all the control, having someone else look over everything isn't always along those lines. But the good thing is that we have a ton of experience in doing this. So if we see something that is a little off, as innocuous as you present us a lease for a rental property that you've purchased in your IRA, and we see the same last name on the lease, we'll ask you, hey, who is this person in relationship to you? And if you say, oh, it's my daughter, she's in college, I bought this house, I was going to rent it to her while she's there, and then I rent it to college kids for the rest of the time, well, we'll catch that and say, hey, you can't rent this to your daughter. It'll cause you a huge issue. As innocent as that was, maybe a small misunderstanding of the rules can be greatly avoided by having it doing it directly here at Advanta. Whereas in the Checkbook Control LLC, once we fund that LLC, the manager of that LLC is going to be the one signing any documents. So that lease could potentially get executed, and that seemingly harmless transaction is now cast in stone and could potentially cause a lot of issues. So really good having us, kind of have a brief eye. And we don't approve these things. We don't vet your tenants. We don't approve the bills to be paid. You submit us something, and we'll process it accordingly. And we process them quickly. Payments are processed. If the request is submitted before 11 o'clock on a given day, the check is issued and mailed out that same day. We don't charge any additional fee for just mailing regular checks. We also maintain copies of the checks, copies of the bills that we pay, any type of inflow and outflow of any type of expense for your account is all record kept by us. So that way you have the record keeping and everything done by us. So if you need bills and stuff like that, you can just give us a call and we do it for you, as opposed to doing checkbook control. Now, the nice thing is that you don't have to wait for something to be mailed. If you're local to that place, and let's say you're working out of El Paso, Texas, you don't have to wait 3 days for a check to be mailed from Florida. You can just write them a check right there, and then your contractor can come in and fix the roof, do some electrical work, whatever you need done. But if that's not always a big concern for you, you can just use the custodial account. You can also have a property manager with an administrator type of account, so you can have that kind of stuff paid immediately by them. You don't always have to utilize a checkbook control type function for that. The other nice thing with the checkbook control is that you can mitigate some fees. As I covered earlier, because we only assess fees to one asset in the account, you're always going to kind of be shielded if you're going to be doing a lot of different investing. But at the same time, let's say you're only going to do one rental property that has a HOA that covers property management and a long-term tenant, the checkbook LLC might not always work for that. We always like to make sure people understand both sides of the coin. And speaking of coins, is that currently, if you were interested in doing cryptographic currencies, you would need to utilize a checkbook control type LLC in order to do that. Presently, we are still working on getting that type of functionality directly in the IRA, but if you're looking to do that, an LLC is how you would need to make that work. And also things like auctions and tax deed sales work really well with having the checkbook control function, where you actually act as the manager of the LLC with a third-party bank account and issue payment directly there and take care of things on a very fluid basis. All right. Okay, Robert asks, is it best to have each rental home in its own checkbook LLC rather than have many homes in one checkbook LLC to avoid a lawsuit that can get all rental home assets? The answer to your question, Robert, is maybe, it depends, and possibly not. The maybe is that you have to look to the state that the LLC is chartered in to see what type of liability protections are offered to single member LLCs. In the state of Florida, the liability protection from creditors typically is not extended to single-member LLCs. So the single-member LLC, from the liability standpoint in the state of Florida, doesn't always hold true with some other states. So then you also have to look at, if it is a single-member LLC, is there any insulation in the particular state that you're using to insulate assets from each other within that? If there is, then potentially. The other way to do it, you could have multiple IRAs. So each IRA in and of itself is considered a disregarded entity from the other one you have. So maybe instead of doing multiple checkbook LLCs in one IRA, you could do multiple checkbook LLCs across multiple IRAs, and it might be a better strategy. Or what I tell people to look for first, if your ultimate goal is liability protection and risk mitigation, insurance. Getting with a living, breathing insurance agent, explaining to them exactly what you're doing with your IRA LLC or your IRA in general, and saying, hey, we're buying property, it's held by an IRA, making sure that the policy is bound to where if you have an issue and you have to go to court, that the insurance agent or the insurance company can't deny claim because it didn't know that it was held by an IRA. And I've seen statistics, and I'm not going to attempt to quote any type of valid statistic on this, but the majority of liability claims and things don't really ever extend past the insurance if there's enough coverage. If you're undercovered, then certainly there is the potential for the people to come after other assets. But making sure you have good insurance, enough insurance, is really the best and first line of defense that you should probably think about when it comes to protecting your assets in qualified retirement accounts. So moving on to understanding the components of an LLC is really important to kind of show, okay, I have my IRA. How does it interact with the LLC? How do I interact with that LLC? And ultimately, how are the assets actually purchased? So starting from the beginning, you have an LLC. on that operating agreement, there will be an owner, which will be titled as the member, which is your IRA. So the member in this case will be titled as the IRA, the owner of the LLC. Now, specifically, it needs to be a manager-managed LLC, meaning that we as the IRA custodian and administrator are not going to be signing anything in this past just the operating agreement to establish the LLC as an entity. So how does everything get signed? Well, there's a manager, and that's typically named as the IRA owner. And the last piece of this is what encompasses all that is the operating agreement. So the operating agreement names the shareholder and names typically who the manager is, although you don't necessarily have to. I would encourage it to be put on there. It is what kind of brings us all together as an investment. It is the investment document that we need to see in order to create the functionality of the Checkbook Control IRA. And we do not do the document drafting for the LLC. We like to refer out to that, one, to help clients get exactly what they need. If they need a multi-member LLC done in a certain state, we like to make sure that they can have that ability. We also like to save clients money. Everyone in the business, everyone here is here to make money in one form or another, but we like to save clients as much money as we can. So in order to do that, we have decided to refer people out. And from what I've seen in the industry, referring people out to have the LLC document drafting done, where it can range from $300 to $600, maybe $700, and that range is significantly cheaper than what I've seen some people do it in-house for. So we like to refer out, although it would be nice to do it all under one roof. We like to save some clients money, so that's why we opt to do it like that. Okay, let's see, got some more questions rolling in. Okay, Ed asks, do I avoid the administrative costs if I transfer funds to brokerage account if I use the Checkbook IRA? No, because we still have to receive the funds back. Transferring in and out, you still have to bring the funds to Advanta first and then move things back and forth. Now, some administrative costs, yes, the actual purchasing of assets underneath of the LLC, you would be avoiding the administrative costs, but some of the in-house stuff, if you're just talking about transfer fees and things like that, would still be assessed because we still have to have the funds come back. You couldn't necessarily just write a check directly from the LLC to another custodian. So a checkbook control investment strategy, how exactly does this work? The IRA owns 100% of the LLC via the membership in the operating agreement. You are acting as the manager. The checkbook control allows the IRA manager to write checks, directly fund investments, pay bills, sign contracts. So the manager of this LLC typically is going to be the client. They're going to be the ones that go out and actually sign a contract. And you can do this at a real estate networking event. If you go to a RIA group or if you go to some other type of thing on a weekend, you can be that first person that jumps up and signs a contract and makes an aggressive offer if you're utilizing checkbook control. Now, we can get contracts turned back around same day, typically within an hour or two, or quicker if need be here at Advanta. But if you're doing something at night or you're doing something on the weekend and that's when you always operate, checkbook control might be a really good fit for you just for those simple facts. But if you do things between the hours of 9 to 5, Monday through Friday, might not always need it. So it's important to understand that, how you like to do things can also determine the amount of potential benefit you're going to see from doing something like a Checkbook Control IRA LLC. Now, the all-important question everyone likes to ask is this allowable? What can I point to say, hey, this is an IRS-approved investment. This is IRS verified. Well, the funny thing is that there's no such thing as an IRS approved investment. Anyone that promotes that or says that is kind of promoting a falsehood, because the IRS does not have a list, does not have a running tally of saying, okay, you can invest in X, Y, and Z, go have fun. They give you general guidelines of what you can't invest in, life insurance and collectibles, and who you can invest with. But if you stay on the right side of those things, everything is pretty much fair game. Now, there are some scenario issues, and some of this stuff has been addressed in tax court and pretty well documented as well. But again, there is still some ability to have some gray area in here. Now, the first big one people like to look for is the Swanson v. Commissioner case in 1996. So Swanson was sued by the IRS and deemed to have been doing a prohibited transaction because he formed a new LLC and then purchased 100% of the membership of the LLC with his qualified retirement plan. They said this constituted a sale of personally owned assets to his IRA and was therefore a disqualifying transaction. So they went to court and they said because it was a newly formed LLC that the shares had not been issued to anyone prior to, he could not have therefore conveyed ownership because he didn't own them. They had never been owned before. So it was not a disqualifying transaction. The interesting thing is Swanson actually turned around and sued the IRS for legal fees and won. So maybe he painted a bit of a target on his back. Not sure if anything ever happened to him after that. But they also didn't address a few big glaring issues in that case. There was a lot of kind of holes left for some interpretation up until about 2013 that was there. One, he was paying himself a salary as the manager of that LLC, which, up until 2013, a lot of people had an issue with, saying, there are some holes in that case. Now, there is a tax court memo from a case in 2013 that addresses a gentleman named Ellis had a very similar LLC that was set up, just kind of like how Swanson did, purchased 100% of the newly formed LLC in his IRA. However, he was personally audited, and it was found that he was paying himself a salary out of that LLC for the management of that entity. Now, that is where they had a problem. He fought and lost, and they said that because it was a direct personal benefit to him to be receiving income from an IRA-owned asset, and he was also therefore had his whole IRA disqualified. So very important in there to understand that there are very fine lines that are drawn on how you can interact with this and how things have to be done in order to be done right. Now, have all the questions for these things been answered? No. But a very large majority of them have been, and we would always encourage you to do your own research. Contact us. Let us know if you have any specific questions. We can tell you what we've seen from other clients and how people have potentially done that to the best of our ability, while maintaining confidentiality. But we can certainly try to guide you as much as we can, and if we can't, we can refer you out to legal experts that can certainly levy an opinion on that. So important ones to look at. You can certainly read more into them. Swanson v. Commissioner in 96 and the tax court memo on Ellis in 2013. Now, LLCs are not the only way to do this. So I like to kind of briefly point out that you can also utilize a trust to do this as well. However, the popularity for the LLC and the ease of use of the LLC typically trumps out in a lot of situations, and it just happens to be more popular. Some people will, kind of expound that the trust is a superior tool, and some people will say no, the LLC is. It's the Dr. Seuss adage of which side of the bread to butter, I guess. But really, they both have their own merits. They both have, essentially the same, benefits and downfalls as one another. We'll review a few of the items on there, but we do have a few questions rolling in. Okay. Okay, let's see. David, that is, I have a friend or business associate with a self-directed IRA LLC, and we are becoming joint managers in each other's Checkbook LLC to provide third-party oversight and management. I would say that'd be fine. Yeah, I mean, trying to keep yourself out of it as much as possible is always not a bad thing. So essentially, what David is asking is saying, hey, my buddy and I both have Checkbook IRA LLCs. Now, instead of each of us acting as the manager of our own, we'll act as the manager of each. So, Dave will act as the manager of Tom's, and Tom will act as the manager of Dave's, just to kind of keep each other as far out of that as possible. And I would say that would certainly be a valid way to do things. Would it be on par with saying that is best practice? I wouldn't necessarily go that far, but it would certainly help, make sure you insulate yourself as much as possible. So definitely not a bad way to do things, Dave. So the trust in the LLC difference. essentially they accomplish the same thing. You can do just as much checkbook control with a trust as you can with an LLC. Just understand that there's a lot more stuff that you have to look for when it comes to utilizing trusts. With the LLC, you have, let's skip back a few slides, you have really simplified stuff. You have an operating agreement, you have a shareholder, and you have a manager. Now, with the trust, you have to not only determine what type of trust you want. Do you want a revocable trust? Does it need to be a personal property trust? You're probably going to need to pay for some time of an attorney to figure out exactly what trust is going to work best with your IRA investment strategy. And also, definitely going to potentially need to look at and see if what you're doing is going to necessitate the need for a third-party trustee. And I would highly encourage you to get a legal opinion on that, because trustees can, in some cases, very easily float into the category of being a fiduciary, and in that case would typically be you would be disqualified from doing it yourself. So the trustee in this case is who is acting as the manager of the trust. The grantor is equivalent to whom the member is in an LLC, and is also going to be the beneficiary in this case as well. So the IRA adding the assets, be it cash, and also the IRA getting all the benefit, being the beneficiary, and then a third party being a trustee. So definitely some other things to think about with trust. Some people really like them. We have clients that swear by them. We have, like I said, clients that swear by the LLC. Ultimately, it's really kind of up to you as the client to determine which one's the better fit. I would say certainly the LLC is much more popular for its ease of use and a little bit more controllability, but just understand that there are options, and that's the biggest thing I like to make sure people understand is the amount of options you have out there is very vast, and just kind of understanding that, if you do want a different route, you can probably find it, and we can probably make it a very seamless transition as well. So we'll do a few case studies. We're getting towards the end, so I do appreciate everyone being with us through this. We probably got another 10 minutes of it. Please make sure you get your questions in. Happy to answer them. Great questions today. Really do appreciate that. It does certainly help people to see more than just kind of what I put together. It helps you see it in a real-world scenario. So if you have any questions you've been holding on to and been kind of waiting for a slide to ask them, fire them off now. We'll get through them, and let's make sure we get your questions answered. All right. So a traditional IRA of $150,000, Checkbook Control IRA. So Joe's interested in real estate, and he decides to buy single-family rental properties. He finds a house that's for sale for $100,000, needs $20,000 to get it ready to rent, and he projects it'll be about $1,000 a month after repairs. So how can he buy the property? Well, like we said, there's options. So purchasing it with the IRA, he opens up the IRA and moves funds over from another qualified retirement plan. The contract would be written in the name of the IRA, which would be Advanta IRA for the benefit of Joe Smith, IRA 800-1234. He would approve the contract by initialing everything. We would sign it as the IRA administrator and custodian, and then we'd issue the escrow deposit from the IRA directly. After closing, during closing, the deed, the HUD, everything's going to be in the name of the IRA, and Joe will need to mark everything as read and approved. Now, all this might sound like a lot, but he can approve everything with our DocuSign portal. He can essentially send all of his forms back and everything directly through DocuSign. So you could close a piece of property in your IRA on your phone with us if you have a smartphone. So it's really not nearly as cumbersome as some people like to make it think. And we understand that real estate closings inherently are time sensitive, so we make sure we get things done quickly. And then after closing, we would have all of the rent sent directly into Advanta. Everything would be paid out by Advanta via a payment request if you ever needed anything, and then you can track everything on your online portal. At the end of this, all of the growth would be captured in the sale of the property directly back into the IRA, and no taxes would be paid, or you could hold it indefinitely. There's no need to actually sell it. There's no type of holding or seasoning period that says you have to turn and liquidate assets on any type of schedule with this. Now, how to purchase assets using an LLC. So instead of Advanta signing everything in this case, the very beginning of this is going to be the same. He completes an IRA application, transfers everything over from an old IRA or 401k, And then instead of us being provided with a contract and everything for the actual purchase of real estate, he chooses to set up an LLC, chooses the name for the LLC. Whomever is going to be drafting the operating agreement is going to help him with the filing the articles of incorporation and getting everything else set up to where it's properly named in the name of the IRA. Once we have all those documents and we see that the IRA is named as the sole member of it, we will then fund the LLC directly in the IRA, so that way he, as the manager, can then write checks, sign documents, open bank accounts, and everything he needs to do with the LLC directly. And then he would be the one that's going to be paying all expenses, any taxes, and anything else like that directly through the IRA, directly through the LLC as well. And keep in mind that the exact same thing works with a trust. There really isn't any difference functionally in how we handle that. The exception being that instead of an operating agreement, we're going to be provided a trust that lists the IRA as the grantor and the beneficiary, and then the trustee will be signing the checks for everything instead of the manager in that case. All right. So let's see. We got some good questions. Okay. John asks, question specific to Georgia. All right, the Peach State. How hard is it to set up a single-member LLC? How hard to set up single-member LLC as simple as possible for this purpose? Attorney necessary. Not. I know for a fact you don't have to have an attorney in the state of Georgia to draft an LLC or file stuff or be the registered agent. Not hard at all. We have people in the city of Atlanta that do this stuff all day long for clients in the state of Georgia, so definitely not a problem. It's just a matter of paying their fee and having them draft everything and file correctly for you. Art asks, does the LLC pay taxes directly or just when there's a distribution to the individual and he pays taxes? There potentially could be an issue where the LLC would have to pay taxes. A good example would be in the state of Florida, if you were operating a vacation rental, you would potentially have to pay sales tax. So in that case, the LLC would need to correctly file and pay sales taxes. If you're involved in a certain type of, if you actually run a business out of the LLC as opposed to just doing investments, you might be subject to a few taxes. But in general, you are correct that the only taxes that would be levied would be when you write a check back to the IRA and then the IRA distributes it to yourself personally is when you pay taxes. So all of the continuing ongoing income and the profits and everything in the vast majority of cases are not taxable. The Rich Dad Advisor said you should never put a tax shelter real estate within another tax shelter IRA. Thoughts on this? I would ask him why. I don't see any real reason not to. I mean, if anything, you would get to you do run out of depreciation on a piece of real estate. So if you hold a large capital asset like that in an IRA and you've run out of depreciation, well, then you're going to start having to pay more taxes on it. Whereas with an IRA, yes, you don't get to take depreciation, but you also don't pay any taxes on anything. And if you have a piece of real estate that is continually kicking off ordinary income, qualifying income, then you can mitigate your taxes over a much longer period of time. Everyone has their own opinion. I never like to think that any blanket statements like some of those people say is always should be taken as fact. I always like to say that there's a good mix of everything. You can have. Should you always do everything in an IRA? Well, probably not. Should you always do everything out of an IRA? Not as well. So making sure you have a good mix of not only asset classes and structures, but where you hold those assets and things like that is certainly a very broad rule that helps people quite a bit. Let's see. What is the difference between articles and an operating agreement? Articles are filed with the state. An operating agreement is not. Articles of incorporation, Benedict, essentially just tell the state, hey, I'm here. I'm operating in this state. Here's my tax ID number. And that's how the state tracks, okay, whenever you see a statistic that says, hey, there are 300,000 businesses in the state of Florida. Well, that's how they know, is because you have articles of incorporation in that state that says, hey, we are an entity operating in this state. The operating agreement strictly is just the confidential document that details the relation of the owners to the actual company, details the limits of liability and the responsibilities of everyone, and essentially just sets up the relationship between the owners, managers, and investment strategies. You are certainly welcome. And then some of the cons. So the pros of the checkbook control and then the cons. You have the quick access to IRA funds for auctions. You can hold more assets with lower fees, and possibly have some more asset anonymity and possible protections. Again, looking to what state you're in to see ultimately what protections, if any, that a single member LLC Sandra, yes, absolutely. I have time this afternoon. I can certainly help you with that. Grab my phone number off the end of this. We can certainly talk. Ed asks, can you add your checkbook IRA over time? Yes, you can. If you're the sole member, you can certainly do additional capital contributions to that LLC. So long as you are the sole member, you can add money in over a longer period of time. Yes, Kenneth, I did misspeak on that. LLCs file articles of organization, not incorporation. Let's see. Damon, when will we get a copy of this presentation, and how do we get in touch with you in the future? Great question. Since we are pretty much running up on the end of this, I will go ahead and throw up my contact information. That's how you get in touch with me right there, 727-754-9954. There's my email. I'll be here today, the rest of the day, till 5 o'clock, and tomorrow till 4 p.m. Eastern Time. Happy to get any questions answered for you. Give me a call, shoot me an email. We want to be a resource for you and help as much as possible with getting the good information to you for making some of these decisions, because there is a lot out there. As we have, I skipped one or two ending slides for that, but nothing that we didn't cover in the main presentation. So again, please let me know. The slides, to answer your question, Damon, we try to get this out as quick as possible. We'd have to do some uploads of the contacts for this stuff and then mail merge everything out, but within a day or two. I'll try to make sure we get this out before the weekend, since everyone has a nice long weekend. And I'm sure what you want to do is review your LLC and IRA stuff over the New Year's holiday. But since you do have some additional time, we'll make sure we get those out to you quickly. Let's see. Michael asks, can I transfer an existing mortgage that Advanta IRA owns for me to a new checkbook IRA? Yeah, absolutely. You just need to have an assignment of mortgage drafted, because there is a recordable instrument associated with the mortgage. So you'd set up the LLC and get everything set up like we reviewed in this presentation, and then you would present us with a assignment of mortgage, and that would go from Advanta IRA FBO, your name IRA, as the grantor, and then the grantee in that situation would be the LLC, and we would just assign our interest over into that LLC, and we would also need to assign that note. But yeah, it's just some documents, time, and a little bit of money to a title company to draft that, so not a problem.